Hey everybody, are you paying too much to trade options? Well, if you're not on public.com, the answer is yes. Public is the only platform where you earn a rebate on every option contract traded, and that's in addition to no commissions or per contract fees. There's no one else out there paying trading rebates, so you won't find a better deal. Bottom line is, if you're paying more than $0 to place an options trade, then you're paying too much. Switch to Public and start getting rebates on every single contract traded, only at public.com. Paid for by Public Investing. Options not suitable for all investors and carry significant risk. Full disclosures in podcast description.
Hey, everybody. Welcome back to Investing Unscripted, where we answer the hard questions about investing. I'm Jason Hall, joined as usual by my very good friend, the voice of the people, Jeff Santoro. Hey, Jeff.
Hey, how are you?
I'm good. I'm good. This is our second take of this intro. We're actually doing the thing that we say that we do. We're literally answering the questions. This is our July mailbag.
Yeah, this is our one episode a month where we actually do the thing we say we're going to do at the top of every episode. We're going to answer some questions.
We are, and we got some good questions. Appreciate everybody getting them into us. Some very relevant ones to some things that are going on right now, like with CrowdStrike. But I love the questions that we have. Some stock-specific ones, some metrics that we're going to talk about, some different ways to think about investing and looking for better opportunities. So it's a good mix. So I'm excited to talk through these questions today.
Yeah, good variety. And what I noticed about them as I went back to put them together is people did what we asked them to do, which is they sent them to us all throughout the past month. So if you're listening to this and you think to yourself, oh, I'd like to ask a question that would get answered on the next month's mailbag, anytime, email us. You can send us an email at investingunscripted@gmail.com. You can DM us on Twitter. If you get our newsletter, you can just reply to the newsletter itself and we'll get it that way. If you don't get our newsletter, you can go to investingunscripted.com and sign up right now. You get a transcript of the show and a weekend newsletter post by either one of us. But yeah, we got these all throughout the month. Good variety.
There's more ways too, Jeff. You could actually comment. If you read our newsletter on the website, you can comment there. You can give us questions on Spotify. If you use the Spotify app, you can ask us questions there. There are lots of ways you can get us questions. This is not a live radio call-in show. So asynchronous communication, send us the questions when you have them. Everybody that did, like you said, I really appreciate that. Before we answer the questions, Jeff, can I call out for some maybe ratings and reviews?
Yes, it's been a while.
Has been a while. Been a while since we asked. We've been nice. So apparently we have to start asking again. So whether you're on Spotify, you're on Apple Podcasts, one of the other formats out there, I will tell you guys, it's really one of the easiest, simplest ways that you can help us, because the better our rating, the more reviews we have, the more likely we are to show up for somebody that's searching for an investing or personal finance podcast. It actually does make a difference in the algorithm. So you can do your little part to help us out without sending us money. You can send us money too.
Yeah, that's fine. Money's fine.
We'll take money. And we've actually made it easier. You can go sign up for our portfolio. We haven't talked about it in a while, but our Savvy Trader portfolio, I think it's doing okay. It's doing decent. We've got another stock pick that it's my month. I'm going to be picking a stock for that. Here probably early next week, I'll make the decision. I've got a couple, and we'll make a video that we'll post. It's a private video that you'll be able to watch about our thought process. Other videos as we pick stocks there. And there's a small community where we engage and we can talk about the stocks in there too. So it's a little more direct stock related kind of way. And if you're feeling generous and you want to give money to us, it's an easy way to do it.
Absolutely. All right. Shall we dive in?
Let's do it.
All right. The first question we got was from Ryan, and he sent this to us on Twitter. Question for the mailbag. I have been noticing in my 5 short years of investing in individual stocks that even great companies hit stumbling blocks and see their valuations drop tremendous amounts, but in the long run recover once the dust settles and those turn out to be really excellent buying opportunities. See the recent examples of Meta, Alphabet, Netflix, etc. I think we could be witnessing such a scenario with CrowdStrike. In the short term, due to the recent debacle with the update that caused massive disruptions globally, I think given that it wasn't an actual virus, but rather a broken process within the push of code to production that maybe wasn't tested or at least not tested well, I think they will eventually be forgiven and return to greatness. So my question is, when you see this kind of a downturn and negative sentiment about a company you believe is destined for further greatness, Do you typically wait a few quarters to see if you are correct with your assessment before jumping in? In the case of CrowdStrike, I believe this could impact sales in the near term and potentially cause some turnover. So, would you be eyeing metrics around sales, net dollar retention, etc., to assess whether you are correct in your assumptions?
This is a lot to unpack. We're actually, you may have heard it before this episode comes out, depending on if and when we do it. But Jeff and I've talked about doing a rough cut for this one because we kind of need to go free flowing and stream of consciousness on it. I'll start with the idea of what Ryan's talking about before I get into any specifics of CrowdStrike, because I think that's really useful as a starting point, because we have to differentiate what's happening with CrowdStrike between the sell-offs of Meta and Alphabet and Netflix, for example. So we'll start with Meta. Meta's business results, their revenue especially, took a big hit because of a cyclical shift in the ad market. Ad buyers pulled back. The CPM prices, the actual per ad price, they fell everywhere that has ad-based businesses saw that. At the same time, Meta was dealing with what a lot of other social media platforms were dealing with, which was the transition back away from kind of the pandemic mentality to doing more stuff in, meat space in the real world. And so engagement was lower, right? And what we saw with Meta, the shift. Go ahead, Jeff.
Well,
You have
and on
some
top
more.
of that, they were lighting cash on fire at an alarming rate in the pursuit of the metaverse. So that was like,
Yeah, no, that's exactly right. And I
yeah,
was going to say, but I wanted to differentiate those two. So there's the revenue rate that was kind of getting squeezed a little because of the cyclical downturn, and their profits were getting hurt more than anything because of, they were earning less money on their ads, but also the amount of money that they've continued to incinerate. That hasn't stopped. They continue to spend lots of money on that, right? So Meta's business was actually completely fine. There was a cyclical turn in the ad market corresponding with everything that was going on with the world broadly. And now their engagement numbers are better and CPM rates are up and they're making massive profits. Netflix, maybe a little bit of the same thing, but also this massive amount of competition that we saw in streaming. Everybody was running out to produce a streaming product. The thing that's really supercharged Netflix, though, was they made an active decision with the ad tier, right? That is a thing that substantially has uplifted their business. So they made a choice to pivot in a way that has materially benefited the bottom line and in a massive way, right? Massive way. I don't even talk about Alphabet. We can just use those two. Now, the difference with CrowdStrike, and I want to use kind of a more extreme example, but one that I think is still, there's a little bit of relevance here, is we've seen CrowdStrike's growth rates come down, but they're still extremely high. In the short term with this issue, with this debacle around their deployment of this update, they screwed up big, right? Massively, and interrupted billions and billions of dollars of their customers' commerce. And a lot of them, like Delta Airlines, and sure, there's probably, at the end of the day, Delta is, internal technology team is on the hook here for not being able to have the capacity to get their systems back online. But that's a lot of money that this is going to hit Delta in one of their peak times during the summer, right? That kind of reputational harm could have much bigger implications for CrowdStrike. This is a nascent industry, right? There's a lot of companies that aren't even using anybody for like this kind of endpoint protection, like in the same way. And that could be that could substantially undercut their growth going forward. I mean, I think we're missing that. But the comparison that I wanted to make is something that's in the retail business, and it's lumber liquidators. You go back close to a decade ago, they had these issues with Chinese manufactured products, some of their composite flooring. There was concerns that it caused cancer because high levels of
formaldehyde.
Like the levels of formaldehyde were supposedly like so high that could potentially cause cancer. Now, a lot of that was more or less debunked, but like the reputational harm to this business was so substantial. The stock price is still down like 90 to 95%. They may go bankrupt now for other reasons, but like it all got undermined because of some decisions they made about their buying and not vetting products, and concerns about the health of those products, undermining consumer confidence in that business that a decade later, the business has not recovered from. So I mean, that's an extreme example. And I don't think CrowdStrike's going to be close to that, but I'm just saying we can't conflate this, what seems like a little blip, to something that's a non-issue that may be much bigger than we think.
Yeah, I think I agree with you. The way that the question's framed in comparing this to other stocks falling for non shoot yourself in the foot kind of reasons,
Yeah. Yeah.
is not a good comparison. And I think
Right.
those can be wonderful buying opportunities if you are smart enough slash savvy enough to see through the short term pain. I was never, just use Meta as an example. I was never a Meta fan. I don't want to own it. I never will own it. But the sentiment around that company back before they kind of turned things around with their expenses, getting their expenses in line, was pretty bad. And that's one of the reasons I picked it in the unportfolio in last year's contest, because I really thought they were going to continue to struggle. And it turns out they had the ability to basically flip a switch and fix a lot of the issues. And that's what they did. And the stock's up several 100% since then.
There is a good chance, if you listen to this podcast, there's a good chance that you use a Facebook product every day of your life, right? So that, that to me is like a measure of potential strength for a business.
Hey, everybody, we'll be right back. But first, a word from our sponsors. FinChat.io is the complete stock research platform for fundamental investors. They have all the standard financial data on more than 100,000 stocks globally. But beyond that, they have company-specific segment and KPI data on around 1,800 stocks. So for example, do you want to see NVIDIA's data center revenue growth? They've got it. Do you like to track Apple's iPhone sales? They've got that too. Or how about nights and experiences booked for Airbnb? You guessed it, they've got it. And they just added around 8,000 ETFs and mutual funds to the platform. The breadth of FinChat's data is truly one of a kind. I use FinChat every single day as I'm researching the stocks in my portfolio, specifically when I want to see how they're doing on KPIs that FinChat is famous for. So to get 15% off any paid plan, go to finchat.io/unscripted. That's finchat.io/unscripted to get 15% off any paid plan today. The link will be in the show notes. Hey, Investing Unscripted listeners, this episode is brought to you by our friends at Yellow Brick Investing. Yellow Brick is an aggregator of the best stock pitches across the internet. By tracking thousands of blogs, newsletters, fund letters, podcasts, and more, they're able to collect and summarize the best stock pitches from all over and bring them to you in one single place. Think of it like a modern value investors club. I have to say, this is pretty cool. I can just type in the company I'm interested in and get a bunch of different stock pitches from across the internet. It helps me think through new ideas and find opposing points of view on the stocks I'm interested in. And the best part is, access to Yellowbrick is completely free. Try it for yourself. Simply go to joinyellowbrick.com and search a company or ticker you're interested in. You're bound to find a great report on just about any company. That's joinyellowbrick.com. So here's kind of what I'm thinking about. Let's continue the conversation as it pertains specifically to CrowdStrike. The comparison I keep coming back to is Chipotle, when it had the health issues that got a lot of people sick. Because if you think about it, both of these were self-imposed challenges that when it comes down to it, really come down to trust.
Yeah.
If you're going to let CrowdStrike be the singular cybersecurity software that you run, and it has the ability to shut your machine down with a bad update, you have to have an incredible amount of trust in the company. And up until now, I don't know of another breach of that trust. You can understand why people placed it there. And I think when you're going to go out and get food and you expect to not be sick, and there's a level of trust there.
Right.
And in retrospect, 2020 hindsight, the best time ever to buy Chipotle stock was right when those people were getting sick, and it looked like that
was that like 2016, 2015?
Yeah, 2015, 2016, something like that.
Yep.
So part of me thinks that's a possible scenario that could shake out here. I think that's more likely than not. I think they'll be fine in the long run. Now, the question is how long, if trust has been lost and therefore so has revenue, I don't know how long it takes to get that back. The bigger question I have around is around the valuation of CrowdStrike currently, because even after falling 30% over the last week or so, it's still an expensive stock. So I I think that has to be something as an investor that you consider. Because my thought after the first day when it was down 13%, I think, was, oh, this might be a buying opportunity. I went and looked and I was like, oh, it's as expensive as it was on like June 3rd. Like, and then the second day actually did knock it back to kind of, I think, where it was at like the beginning of the year. I think it's only up like 3% year to date now. So
Right.
that's a pretty significant haircut. But still, like as of today, because I happened to look again, it's trading for, I have it as enterprise value to sales, which is close to price to sales of still 19 times. So it's not like it's, trading
Yeah.
for some low multiple. And I just don't know if this will be like a slow bleed where it's less a month from now, it's less 3 months from now, it's less 6 months from now. You know, I, a good slash bad thing is we're heading into earnings season and they report near the end of it. So we'll
Right.
get updated numbers then, and I'm sure we'll get more commentary. I think the last thing I want to say, one thing I read in an article today or yesterday was management has started to put out into the world the things they will do to ensure this doesn't happen again. Like, so for example, they said they're not going to push updates out to everyone all at once anymore, which seems so obvious. I'm not sure why they didn't, why they ever did that.
Yeah.
But basically roll it out. They call it actually, something like canary in the coal mine.
Mhm.
Send it out to some people, see if it's okay, send it out to more, see if it's okay.
So
But
my
that I bring
question
that
is,
up
if
because
I'm one of the customers that gets them first, do I get a discount?
I hope so.
If I'm the canary, do I get the special
Well, but you would think, the
price?
people who get it first are not airlines and hospitals.
Yeah.
But to me, so I guess the reason I bring that up is I think that's what you want to hear from management if you're a customer debating whether you want to switch vendors. You want to hear like, okay, you screwed the pooch here. What are you going to do to make sure this doesn't happen again?
Right.
And the last thing I'll say is I did have a conversation with someone I know who works for a competing company. And the first thing this person said to me when I asked him what he thought was, dude, they're the leader. Like that was the very first thing out of his mouth. And he works for a competitor. He's like, it's not even a question. They are the leader in the industry.
Right.
And I think that goes a long way. And I think that's going to make it harder to, damage the company's reputation to a point where it can't come back. So let's answer the question about what do you do? To
Right.
me, I think it's all about position sizing in everything with this. So like I could see a scenario where you say, I'm just waiting to see what happens.
Right.
I could see a scenario where you sell.
Yeah. I
And
mean, that's exactly right, because 0 is a position size.
yeah. And I could also see a scenario where you go, you know what? I'm not sure, but I'm willing to bet another 0.5% of my portfolio that this is going to turn around.
Right.
So I think it depends like how much of your portfolio CrowdStrike is. Like if it's already like 10% of your invested wealth, I don't know that I'd be adding, but as for me, it's, all my stocks are a small percentage. So I was thinking about maybe adding a little bit and just sort of like a hedge in case this really was just a short-term blip, that's fine, but not so much that if it drops another 30%, I'm going to be hurt.
Right.
I think that's the way I would approach it. If I was going to make a decision, it would probably be around like how much of my portfolio is already CrowdStrike stock. And then also how much do I want to bet, so to speak, on this being a shorter term challenge versus a long term one.
Yeah, I think that's exactly right, broadly, with a little bit of nuance here too, because I think the easy knee jerk is for anybody that's bullish on the business is to buy, right? And I kind of thought the same thing too. And then I slowed my process. I put my process in place, right? I went through my framework, which a big part of my framework is if I decide to buy a stock today, I'm not allowed to. Like it's one of the fuel. It's not completely hard and fast, but in this sort of scenario, I absolutely throw in that, I've got to wait at least a, market day or maybe two before I act, because you're never going to beat the smart money, right? Number one. And as we saw, first day this was down, I think it closed down maybe right around 10%. And then the second day it was down like 11 or 12% from that drop. So it was like a 22 or 23% drop in total between those 2 days. And it's down about a third from the high this year. So generally patience is a more valuable approach for us individual retail investors than trying to beat somebody else to hit the sell or the buy button. and it gives you time to think through the greater implications. And for this one, part of my thought process has been, okay, so what are the kind of near-term threats? And the near-term threats is you lose some big customers or you lose some big deals. The longer-term implications is that snowballs and, you've eroded customer confidence in a way that your growth rates get cut down substantially. Because like you said, it's still around 20 times sales. There's still a ton of growth priced in, even with the sell-off that we've seen. So the expectations are generally still bullish that the business is going to keep growing at a pretty high rate. I'm willing to, and again, it gets back to position sizing. This was probably 1.8% of my portfolio now on a cost basis. It's around 1% of my cost basis. I'm okay right now to let this play out a little more and to get some business-based evidence. Is this impacting their sales results, right? Are they going to have to start discounting? Is that going to affect their margins? Because customers, I've got a friend that's in cybersecurity, and he's a decision maker on these sorts of deals. And the organization that he works for went with a competitor. They went with SentinelOne, and price was part of it. And how many customers are going to go to them and say, look, we appreciate the technical advantages, but we're just not convinced at this price that SentinelOne or Microsoft's competing product is not going to be good enough for what we need. So I want to see some financial evidence. We're not going to really get much of that this quarter. They're going to sell a good story, right? I think their quarter ended at the end of June, maybe. I don't think it ends at the end of July.
I think they're June 30th, I think.
So we won't really even see any of the financial implications. There won't be any of that period until, another quarter from now. So management's going to be on. Go ahead.
I was going to say, so I know we won't necessarily see the results in what they report because it'll be those numbers are static from before this happened. But so let's get to the part of the question where he asks what to look for. So number one, I want to hear management talk about this a lot.
Yeah.
I want to hear a lot of I'm sorries.
I will say, Jeff, I'll say this. I think it's important because we've seen that. I don't know if it was their CTO or CIO.
His statement was better, but George Kurtz was a little bit like, "Hey, it wasn't a cyber attack."
Yeah.
Like,
but my greater point is, he said we screwed up, right? This was our mistake. That message doesn't get pushed out past their legal review team if they have substantial legal risk by them admitting responsibility.
Yeah.
Right. So that reassures me to a certain extent. They're
agreed. But I want to hear more of it, and I want to hear some color on what phone calls have you been having? Who has called, not who specifically, but have vendors been calling? And the analysts are going to ask those questions. As it pertains to the numbers, I mean, you hit on some of them, but this is what I'm going to be looking for. When we do get solid numbers. So that might have to be when the next quarter gets reported, not the one that we're going to get in a few weeks. Certainly all the normal stuff, revenue, but I want to look at net dollar retention rate, because you could see a scenario where someone had 8 modules with CrowdStrike and maybe they go, you know what, let me roll back to 4 and I'll get this other stuff covered by someone else just so I have less exposure to one business, right?
Yeah.
And then, new customer growth, because obviously if someone was considering CrowdStrike and another vendor last week, maybe this helps make them make their decision.
I highlighted that on a video that we put out on our YouTube channel a couple of weeks ago. It's not just that they're growing existing relationships, they're growing new customer relationships. Right. Both are growing at very high rates.
Yeah. And then the last thing is margins. You mentioned that in terms of, they might have to say to some existing customers who are up for renewal, hey, listen, we screwed up, come back for, 80 cents on the dollar or something like that. Just to kind of sweeten the pot. So, all right, we've done about 20 minutes on CrowdStrike, so we
have. The good news too is that this basic theme, I think maybe it's our last question, has got some similar things that we'll talk about too.
Yeah. All right, let's go to the next question. This came from Bo via email, and he says, "Why is the stock market compressed into a 6.5-hour day? Yet we have extended hours and some platforms that trade 24/7. Wouldn't a slightly longer day of 8 hours be better and slightly control volatility, especially during the earnings season since most report after hours? What are your thoughts?
No, I don't think expanded hours would necessarily help a lot with that. And the reason why is that the people that would benefit from expanded hours are mostly retail individual investors who are looking for the ability to trade when they're not at work. The vast majority of the volume is not coming from us, right? So I think that's important to remember, that I don't think it would necessarily, maybe it would a little bit, but I don't necessarily know that it would matter a lot.
I think there'd be massive liquidity issues if we had a longer day
Yes.
or 24/7 trading. You have to think
Right.
if you're, you know, and I think it would lead to like
There
probably
have to be
some,
two parties to pull off the
right.
trade, right?
Yeah. I the first thing that jumped out to me is there's been so many frictions removed from investing, and I think largely they've been good. Not having to pay commissions to trade, being able to buy fractional shares, being able to do it easily on any device. But that has also made it very easy to gamble in the stock market
Yeah.
and or conflate investing with speculating and gambling. And I think the longer you extend the trading, probably makes that more likely. And I also think too, like, there's gonna be stories about someone who tries to buy, an illiquid stock even when the market's in its normal hours at, like, 2 in the morning, clicks the button, some weird spike happens, they pay 6 times what
Yeah.
they were thinking they were gonna pay
Right.
because they didn't do a
Well, if you
limit
put
order.
through, and that's why I think every brokerage that supports any sort of after hours or before, like non-market hours trading, they force you to use limit orders so you don't get hosed
Yeah.
by somebody that knows idiots do that and they take advantage of. I shouldn't say idiots, but people that just don't have the knowledge of how that can work. So yeah, I mean, sure, maybe it might help some, but I don't know that it would help with volatility or really be as beneficial as most people think.
Yeah, I would not be surprised if it happened just because that seems to be the way things trend.
Yeah.
I would hate to see it personally, like, just, again, this is my perspective as someone who spends a lot of time thinking about the stocks in the stock market. Like,
Right.
I like the fact that I don't have to do it from 4 o'clock on Friday to 9:30 on
Mhm.
Monday. And, it's like, it's nice to be able to turn my brain off and I know that, like, all right, everything's exactly where I left it until I come back on Monday.
Well, and one
Um,
other thing too, a lot of people don't know is like you're you're not necessarily just trading when you buy a Nasdaq stock on the Nasdaq exchange or on the New York Stock Exchange. There are market makers that these broker dealers that your online brokerage is through often work with, and they're usually hedge funds. That's part of their business is like you might buy a stock for $10 and they make the market, right? And maybe you're buying it from their inventory because there's not necessarily a seller lined up on the other side, but they might have paid $9.99.4 for that stock, right? So that's, even though there's no trading fees, they're profiting from it. So I think every time the market expands a little bit, the market makers are the ones that are going to find a way to profit from it. And I don't necessarily know that it's going to be super beneficial for retail investors.
yeah, agreed. All right, next question comes from Andrew, who sent it to us via email. And Andrew says, you've had a good amount of coverage on SOFI recently. Jason specifically has been pounding the table for a few months now. I'm curious if you have an opinion on Ally also. Seems like a similar business with a primarily online presence, but not entirely sure. Maybe you could share thoughts on the two businesses and the two stocks. So I don't know much about either of these, so I'm going to let you pontificate on this one, Jason.
So to retail bankers, to people looking for banking products, Ally and SoFi might seem really simple. They're web-based. They have high yield savings banking products that they offer. But that's really about where the similarities end. SoFi, of course, is a new public business. It's been around maybe a little more than a decade since it was first created. Social Financial is kind of like a cloud or a crowd-funded lending platform for student loan refinancing, and then it got turned into a bank over the past few years. And their student loans is still like that's their biggest lending business, and pretty high rates, interest rates that they get. They also have a credit card business that's pretty high rates. They moved into mortgages as they've tried to diversify and kind of expand across different, commercial traditional banking businesses. Their timing for that's been really good because they've really focused on growing it in recent years when interest rates have moved up. There's not a lot of volume for it right now because demand's high, but supply's weak. But they get 7% mortgages instead of 2.5% mortgages. And because of the way their deposit funding works and their funding model with those high yield deposits, that's kind of how they've begun to evolve their business. They also issue a lot of stocks. Share count's up like 30% over the past 3 years because it's a tech business too. So they pay based on how most tech companies do, less like a bank does. Now, also it's just become profitable, right? It's just crossed into that threshold of profitability. Ally Financial's been around, its corporate history goes back to 1919 when General Motors started a finance arm to lend money to sell cars. It's been around for a very, very long time. And the legacy of its business is still tied to its core business, which is mostly auto lending. More than half of its loan book is auto loans. Its commercial auto loan book is bigger than its entire mortgage loan book. Just its commercial loans, not even talking about like its retail auto loans to regular people buying cars. Has 190 plus billion dollars in assets compared to like 31 billion for SoFi. So is there growth potential there? Yeah, I mean there's growth potential, but it's 6 times larger than SoFi and still mostly kind of sticks to its own knitting. They have some mortgages and other like traditional banking stuff that they do, but really auto lending is kind of the core. If you're buying Ally, you're looking at it more as a value play because their earnings have come down a lot over the past couple of years of interest rates have gone up because their cost of capital has gone up more than what they're getting on loans, auto loans. So their interest margins have gotten a little bit squeezed. So if you're buying it right now, you're buying it on its ability to kind of normalize its earnings and grow its profits and earnings per share. So it's kind of a value play. Also pays a dividend, yields like 2.9%. So more of a traditional kind of buying the bank when the stock price is weak based on its ability to grow its earnings. And SoFi is more of just you're betting that it can grow its earnings per share a lot faster than they're going to be issuing stock to employees.
Yeah, I said earlier, I don't know these businesses very well, but something you said got me thinking. If there's anyone listening who's interested in, but not necessarily an expert in investing in banks, like one thing I've noticed in my time paying attention to this stuff is banks often get thrown together in the conversation, but some banks do certain things that other banks don't, and they're not all equal. And I think if you're into investing in banks, it's worth digging into exactly what they do and where their money comes from. I own I own a few financial stocks. Like I own Schwab, and they're an interesting one because yes, they have checking accounts and savings accounts and credit cards and things like that, but they also have a brokerage and they do a lot of asset management. So they're in like a different part of the banking sector than maybe Bank of America is, and then you have and then there's like the whole branch, so to speak, of the online banks, and some are heavy on loans and some are really checking and savings, and they all kind of do different stuff. So
Well,
I
like
guess,
I here just this is a fun we'll do a fun little game here. Goldman Sachs, Truist Financial, Axos Financial, Live Oak Bank, SoFi, Ally Financial, all 6 of them have very different business models.
yeah,
And then you have Bank of America, which has a very different business model as well, which is literally doing all of the things that all of those others do.
right.
But
And
those 6 all do things differently.
yeah, and that's why you'll see like the banks that are heavily involved in helping companies do IPOs will struggle during a time when IPOs dry
Yeah.
up. So it's
That's
just
like a Goldman Sachs,
right.
a investment bank, right?
Yeah.
Hey, Investing Unscripted listeners. My name is Brett, one of the hosts of the Chit Chat Stocks podcast. If you love Investing Unscripted, we think you will love listening to Chit Chat Stocks. On our show, we research individual stocks, interview investing experts, and, well, chit chat about investing every week. From hot stocks such as Nvidia and Celsius to hidden small cap gems, we have something for every type of investor. Follow the Chit Chat Stocks podcast on YouTube, Spotify, or Apple Podcasts and level up your investing skills today.
Earlier in the show, you heard us talk about investing platform public.com. That's where you can trade options with no commissions or per contract fees. And you get a rebate of up to 18 cents per contract traded. NerdWallet recently gave Public 5 out of 5 stars for options trading. If you want to see why, go to public.com and start getting a rebate of up to 18 cents per contract traded. Paid for by Public Investing. Options not suitable for all investors and carries significant risk. Full disclosures and podcast description. U.S. members only.
Exactly.
So
Okay.
anyway, that's the only thing I can contribute to this question. All right, let's move on to the next one. This comes from Richard, who says, I've been following your show for a month now, and I love it. Thank you, Richard. Happy to have you here. I just discovered the mailbag concept, and I have 2 questions for you, both about Brookfield Renewable. The first one is about the difference between BEP and BEPC, which are 2 Brookfield tickers. I'm having a hard time figuring out why BEP is cheaper and why I can't buy it with my broker. What is a limited partnership and what makes it different from a corporation? And how does Brookfield Renewable relate to Brookfield? Furthermore, I am curious what you guys think about HA Sustainable Infrastructure, ticker symbol HASI. It's very similar to BEPC, both in yield and expected growth. It is, however, a lot smaller and could thus grow more easily. What do you think? Which do you prefer?
Richard, welcome to the club. It's awesome to have you listening. So those of you that have been around for a while, go ahead and get your glasses. It's time to do a shot because I'm going to mention Brookfield, right? So
my investing unscripted bingo card is entirely, every box is Brookfield.
Yeah. So you're going to fill out the whole thing right here in this one episode. So let's start with what the difference is between a corporation and a limited partner. So, because this really matters to the Brookfield group of entities, because whether it's Brookfield Renewable or Brookfield Infrastructure, there's a 3-digit ticker, which is the publicly traded partnership. And then there's the 4-digit ticker, which is a C corporation. So it's like Coca-Cola, it's kind of this structured in that same way. So the difference is that a publicly traded partnership is more like a REIT, a real estate investment trust, than it is like a regular corporation. So it's a pass-through entity that has lower or no corporate income tax that it has to pay. They're largely pass-through entities where the unit holders, which is us, it's like a shareholder, but they trade in units, not shares. The tax liabilities are passed along to us. So it makes them very, very tax efficient for things like dividends, right? Because you don't pay corporate tax and more cash you can pay out to your shareholders. So sounds like a REIT. It's kind of the same thing. The difference is that REITs are generally easier to own in things like retirement accounts, Roth, 401k, if you can buy stocks in it, rollover IRAs, all that kind of stuff. We mentioned this on a previous show, UBTI, unrelated business taxable income. Limited partnerships, they're really common in the energy industry. Like pipeline companies, a lot of times may have a spinoff that's an MLP, which is master limited partnership, or that might be the entire business is structured as an MLP. If they own assets or operations or have interest in businesses that are not related to their primary business, income derived from those may be classified as UBTI. I'm not an accountant. If you have this, you need to talk to an accountant, not listen to a guy on a podcast. But the short answer to your question, Richard, about your brokerage maybe not allowing you to buy BEP is because of the risk of UBTI. Inside your retirement accounts, if the investments you hold in retirement accounts, all of them, it's not just that one account, it could be 2 or 3 accounts, even in different brokerages. If they generate more than $1,000 of UBTI combined, it becomes taxable. So there's a risk of tax and complications because of that. So a lot of brokerages just won't let investors even buy MLPs or publicly traded partnerships like the Brookfield partnerships inside of retirement accounts specifically. You might have a taxable brokerage they let you do it in. You're going to get a form, Schedule K1 come tax season from them. They're more complicated. The good thing is like all the online tax software just They have a thing, you just plug it in and it makes it pretty simple. Your accountant has software too that they just plug it in. So that's the short version. The long version of the reason why your brokerage probably won't let you buy the partnerships. That's also the answer to the question is, why is the yield different? The stock price tends to be lower, pushing the yield. They pay the exact same yield. BEP and BEPC are not yield. They pay the exact same dividend. But because the owner of the units carries on more of the tax obligation, it's not as valuable, right? So the price trades lower to offset that tax obligation that you're going to, so it should net out to a similar after-tax value to the investor. Does that make sense, Jeff?
Yeah, I mean, I used to be confused about this too. I used to own BIPC, and I don't anymore. I think the bottom line with it's good to ask these kinds of questions when you see two versions of what you think are the same company and why they trade differently. But
Yeah.
the thing that always kind of gave me solace when I was confused by it was there are very few like obvious inefficiencies in the market, right? So if there was
Right.
ever a chance where you could get this version of a company for cheaper than that version of the company, like truly cheaper,
Right.
that wouldn't last for more than a minute before algorithms for these big trading houses would figure it out and do the arbitrage, and the prices would come back in line.
Yeah.
So it's a good thing to understand and know why.
Right.
Like what you said, like it nets out in the end as being the same because you have to think about the different tax
There
implications.
was this weird period in time. I can't remember if it was renewable or Brookfield Infrastructure, but there was one period of time where the corporation, the 4-digit ticker, actually was around the same price or cheaper. And it just completely didn't make any sense. And I added at that time because, again, if you own the corporation in a taxable account, the dividends are going to be lower. So I took advantage of that opportunity when I had it. But yeah, generally the market already knows, and there's not a secret that you're going to be in on.
Right.
So, but I will say, in a taxable brokerage account, if the prices are very close, buy the corporation. Generally, is the way to think about it, because your taxes, it's a qualified dividend, so it qualifies for the lowest tax rate you can pay on a dividend. So that matters. Should we answer the next question?
Well, you mean the next part of the same question? Yeah,
Yes.
let's
Yeah.
talk about HA sustainable infrastructure real quick, and then we'll move on.
Yeah. So formerly, they followed the route of Dairy Queen, and they rebranded to DQ. So HA Sustainable Infrastructure, I'm old enough to remember when it was Hannon Armstrong. It was like a year ago. It hadn't really been that long. But so thinking about it compared to Brookfield Renewable, they're similar in that their core business is investing in renewable energy assets, right? Long term. They do like a lot of like structured debt deals and that kind of thing. They're not just necessarily like an operator like Brookfield often is with these sorts of assets. So that's a little bit of a difference. There's also a difference in the assets they own. So Brookfield Renewable started off buying hydroelectric dams in Latin America. And then it's only been in the past 7 or 8 years they've moved into wind and solar as the cost came down a lot and the opportunity to profit became readily apparent. And even more recently than that, they've moved into distributed solar. So utility solar, this is the producers that are selling the power to somebody that needs to use the power. So selling it to a utility or a grid operator, or maybe selling it to a large commercial power user like a manufacturer or Alphabet that's running a bunch of data centers, and Microsoft. There's some Brookfield Renewable and Microsoft actually just did a huge deal for power. So again, they're producing power, feeding it into the grid, and somebody's using that power. Distributed solar that's like rooftop solar, like on your house or on a business, where it's offsetting your use, right? You're putting that power back in the grid to offset the power that you're using. Very recently, Brookfield has moved into like owning and managing some distributed commercial scale solar. Hannon Armstrong, like they do like all kinds of stuff that they like rooftop solar that they funded, like basically the debt on funding that kind of stuff. So there are some differences in the business model. Now, where maybe they're starting to overlap is that Brookfield Renewable is part of the Brookfield Corporation family of entities, which includes Brookfield Asset Management. It's one of the largest asset management businesses in the world, where some of their funds, where they have very high net wealth individuals, pension funds, like people that are managing billions and billions of dollars come to them that want to invest in alternatives to stocks and bonds. Some of their funds are focused on renewable energy, right? So there's like a co-investment vehicle that Brookfield Renewable can be used for because they have the experts on acquiring and operating those assets, right? So it's access to capital that Brookfield Renewable has there. KKR and HA Sustainable Infrastructure recently struck a deal for like a $2 billion fund that they're going to be deploying capital into. So that's helped increase access to capital for HA. So that's kind of good, but it's still not as good as the direct relationship that Brookfield Renewable has. I want to push back on one thing Richard said here, said that it could be easier for HA to grow because it's smaller. That's not how it always works, particularly in these big markets like this, where access to capital and scale can be really, really valuable to be able to grow, right? Some growth rates might seem like HA can grow faster. I don't necessarily know that that's going to be the case, especially with like the residential solar market's a mess right now. So that's one of the things that's really hurt HA, because they do a lot of that kind of debt and that market's really down right now. There's a ton of industrial demand. Tesla just reported earnings and they sold double the amount of utility scale batteries last quarter than they did year over year. So utility scale renewable demand is still really strong. So I really do prefer Brookfield just because they have such a great history of executing and proving that they know how to make money. HA stumbled a little bit more, and being smaller and more nimble isn't necessarily a benefit because cost of capital is so important in this sort of business.
All right, let's move on to the next question from Alex. This is similar to our first one, Jason, so I don't think we have to spend a ton of time diving into it. So Alex writes, what do you think about the idea that high quality companies with stalled growth rates are one of the best areas for potential returns? And if so, how does one improve their ability to identify business performance pullbacks that are only temporary? He gives two examples. I'm not going to read them just for the sake of time, but he asks, goes on to say, I'm looking at several companies in my portfolio that are still in the midst of slumping revenues and a stalled share price. To me, this has been an interesting thing to think about and gives me hope for some of the laggards in my portfolio. Do you think it's possible to become skilled at finding these opportunities, or is this a dangerous game of speculation? So I don't think it's speculation. To me, it's all the why. I was thinking about this recently. You can become a lot better of an investor by simply doing two things: noticing and asking yourself why. And I think if you know the reason you own those businesses and you know what drives their results, and then things aren't going well, that's the thing you've noticed. And then the question is why. So the two companies he mentioned were Netflix and Meta, which we already talked about earlier, which is why I didn't need to bring up the examples. But, just to pause on Netflix for a second, when they were really struggling, it was pretty obvious why. Year-over-year subscriptions fell for the first time in like forever. And so the question you had to answer for yourself as a potential investor or a current investor is this temporary, or will they figure this out? And if you said to yourself, they've figured every other challenge out, they'll figure this out, and held your shares or bought more, you did well. I probably would have done the same thing back then as I am thinking about doing with CrowdStrike, is maybe buy a little more in case I'm wrong, and then add as the confidence goes higher as results come in. So it's kind of my same answer as before. Like it boils down to me, like knowing why you own the business, knowing what drives the business, and then making your best decision you can about whether you think it is a short-term problem or not. And I'm in the same boat. There's a bunch of companies I own that the stock's kind of lagging along and the numbers are not great right now, but I'm holding them because I truly believe it's just a short-term challenge. Like every company goes through those. Just as a quick example, Old Dominion Freight Lines just reported this morning, and I remember thinking for the last several quarters, like, man, things are heading in the wrong direction. I know this can be a cyclical industry. And then all of a sudden, this is the third quarter in a row where revenue growth has increased. So it's kind of starting to tick its way back up. And I never added to it because even though the numbers were not great, it's remained expensive this entire time. So
Right.
I wasn't really worried that the market was seeing something that that I wasn't seeing. So that's one example. All right. So what do you want to add on to this similar question?
Yeah, I think it does. It starts with exactly what you're talking about. You need to know your companies really, really well. That is so, so important to being able to identify these opportunities. The
Yeah,
danger there,
because if not, you'll just get taken by the share price.
100%. That's exactly
the big
right.
reason.
That is the tail that will wag you, right? It's absolutely right. But the caveat that I want to put in there is that sometimes we bias ourselves too much when we know our companies too well, and it's a sunk cost fallacy, right? Where you take the time that you've invested in that knowledge to bullish assumptions versus letting the information take you down the path of finding the more likely answer, right? So I think that's really, really important. So an example that I'll use for me with Netflix, I want to go way back. I'm going to go back to like 2011. Do you remember Quickster, Jeff? Do you remember? Yeah.
Yeah, I
So
mean, I wasn't paying attention to stocks at that point, but that was a big enough news story that I do remember it.
so the short version, this goes to back when Netflix was still making a ton of money, actually mailing DVDs to people's houses, Blu-rays at the time. But that was still a really important part of the business, and streaming was just starting to become the bigger, more important business. And Reed Hastings pushed too hard with the idea that they were going to split the business apart, and they were gonna split the mail off business. They were going to rename it Quickster. Like I think somebody even like already had somebody had the Twitter handle or there were social media properties they didn't even own, and they announced they were going to do this thing, and prices were going to go up, and then they reported earnings, and their membership numbers actually went down. I think that was the last time before this most recent time, a couple of years ago now, where membership numbers went down I don't think it was year over year. I think it was just from like the prior quarter, like from the third quarter, they went down from the second quarter. But the market freaked out and the stock fell like 70%, like crashed. Part of that because the stock was wildly expensive, like wildly, wildly expensive. Remember that summer, the stock price had gotten to, it's much lower now because like on a split adjusted basis lower, but the price back then was like $275 a share. I'm like, I'm not touching that stuff. That's no way. And they bought back a bunch of shares that summer. And then the Quickster thing happened and they had a backlash and membership numbers fell. And they actually ended up issuing stock when the stock was down like 40 or 50% to raise some capital. And the stock kept falling when they did that. But it became obvious to me that this is like just a really high quality business because they stepped back the whole Quickster thing quickly and it's like, look, that was stupid. Long term, maybe that's the right thing to do. But right now, you've spoken loud and clear. Our customers, these things need to be integrated, needs to be together. So they walked all that stuff backwards. I bought some stock during that period. And a few years later, the proceeds of that stock funded the majority of the down payment on a house for us. So I got lucky with the timing of the stock bouncing back, but it was really in hindsight, a pretty obvious opportunity to buy a very, very good business on perceptions about this struggle. I'll say that. And then what did I do, Jeff, this most recent time with Netflix?
There's a rough cut video or
Yeah.
audio that people can go listen to.
Where I mea culpa'd, but a year before we did that rough cut, the short version is that you asked me, like you said, Netflix looks like an opportunity to me right now. And I'm like, yeah, it's dead. Here's the difference. The difference in that decade was a decade before I knew the business like the back of my hand. I haven't owned Netflix stock in years, and I haven't followed the business anywhere near as closely. You have been following the business.
Well, I don't know. I think the biggest difference there, and honestly, I did see opportunity where you didn't, but I think you can't really fault people back when that happened from questioning, like, is this finally the end? Or not the end, but is this finally, because I think the point you made in that text conversation that led to that infamous call of them being toast, I believe was your exact quote.
Yeah, it's toast. It's toast.
Was
That's right.
basically that I think you wrote back to me like, dude, they've never had competition and now they do.
Yeah.
And I think
Yeah.
that's a perfectly valid, again, it's hard to look back and and see
It's
it.
valid, but if you don't do the work, it's lazy analysis. And it
but
was
it's not
valid
a
yet lazy
stupid,
analysis.
it's not an unreally. Now, I think you didn't sell it at that time. I don't think you owned it anymore. So
I
it wasn't
didn't.
like you,
I didn't own it at
yeah.
the time.
And I didn't either. I was still kind of tracking it after I had sold it. I think probably because I was writing about it. And I was like, I don't know if I see what everyone else is seeing here. But that's, again, easy
Yeah.
to say when I'm not. I don't have any
Yeah.
skin in the game. So,
But I think, again, it's to summarize all this, it starts with understanding those businesses extremely well and being willing to quickly acknowledge when the thesis has changed and it's not an opportunity to buy and it's a yellow flag or maybe even a red flag with the business. I think you have to start there because that's where the skill is going to live, being able to discern those two things. And back to what you were talking about earlier, because it's not always binary, being able to make a judgment on the risk reward continuum and think about position sizing to manage if you think it's an opportunity without exposing yourself to permanent financial harm.
yeah. And the way that I'll wrap up my part of this question is just simply 99% of the time, there is no reason to make a decision immediately in terms of what you're
Yeah.
going to do.
Yeah.
Just using CrowdStrike, going back to that as an example, down 10-ish% the first day, down 14% the next day. Then it was up like 1% yesterday, and now it's down another 3 or 4 today. Now today's a day where the whole market crapped the bed, so that's part of it too. And so unless you were like, I need to sell immediately and get out, maybe you saved yourself some cash by doing that on that first day. But in terms of people who are thinking of adding or holding, there's plenty of time to let the dust settle and kind of think about it. All right, we're nearing an hour here, so let's wrap up with our last question. I think it can be a fun kind of quick one to wrap up at the end. This comes from Andrew via email. Hope summer is going well for you both. Thank you, Andrew. Same to you. Could you give your thoughts on the PEG ratio, PEG? Does it have a place in your analysis of a company? I've personally never used it, but just got sucked into a rabbit hole of articles and videos. So curious about your thoughts. So I want to start with this one and then you can wrap us up.
Do you want me to define the PEG ratio or you want to do it?
So it's basically, if I have it right, I'll have it in front of me. It's price to earnings divided by the future growth.
Price to earnings growth. That's
Yeah.
what it stands for. Yeah.
And when I was a new investor and I was obsessed with like learning all these little ratios, right? I came across the PEG and I read articles about it, probably just like Andrew is, and everyone gets very excited. Like it's like a cheat code. Like it's better than the price to earnings because it factors in growth, and and it's like if it's under this number, then it means it's undervalued. And it's like the articles you're going to read about it present it like it's a magic formula that you can just apply and then make a decision.
Right. So the short, like a PEG of 1, for example, means that it's priced at a fair value based on its growth rates.
Right.
That's
More than
essentially
one
what it
is
means.
expensive, under one is undervalued. But here's the big thing. This is why I don't ever look at it. Every forward projection, whether it's from the company or an analyst or your own discounted cash flow model, is an estimate.
Yeah.
And
Yeah.
this entire ratio is based on someone's best guess about what.
Well, these are
future growth.
consensus analyst estimates. That's what the PEG ratios that you see are based on.
Right. But
Yeah.
how often, what's the first thing that comes out when a company reports earnings? Company X or whatever reported, beat analyst estimates. Company Y reported, missed analyst estimates.
Yeah.
It's never company reported and hit the analyst estimates exactly right. I mean, that does happen, but so it's all a guess. So I think it's fine to look at it. I think it's fine to consider
It's
it.
an input.
It is an input.
Yeah.
It is certainly not. I don't know. I stay away from anything that's a forward-looking estimate because it's just a guess. I just don't. I don't care. I'd much rather. I stole this from Jason Moser, who we had on the podcast a few weeks ago. I'd much rather just hear what the company says they're going to do and then see if they're going to do it, rather than the consensus estimate. So, all right.
So yeah, I never use it. I'm going to build on a little bit of what you're saying there too. So so number one, it's a future estimate, right? And is it a PEG ratio based on 3-year, 5-year, 12-month? All of those things kind of come into play too, right? So you're normalizing based on those estimates. Those estimates come from the analysts that cover the businesses, like we talked about, and these are useful people, and the reports they put out and that kind of thing are helpful and handy to building your knowledge of a business or an industry. But again, like I said, they're estimates and they change them all the time. And guess what? They're adjusted. They're not GAAP. So if you're thinking about a PE ratio, that's their GAAP earnings, right? So these are adjusted. And chances are, if you're using it for a growth stock. Growth stocks, generally, you don't want to, very few of them are you basing buying it or selling it on a PE ratio anyway, right? Maybe price to operating cash flow, or with some mix of like price to revenue and looking at gross margins and other things too, to like figure out like the monetary value of the business. So it's nearly useless to me. So I don't use it. But thank you for getting us that question, because that question was useful. Thank you, Andrew.
Yeah. I mean, yeah, a lot of these ratios get presented in articles you read as like a cheat code for figuring out what to buy. And the reality is, again, if anything was that easy, we'd all be losing to computers.
There's a very good chance if you're reading an article and they use the PEG ratio, they're using it because it justifies what they were trying to tell you.
Yep.
That's it.
Agreed. All right. That's the end of the mailbag. Once again, as a reminder, if you have a question that you'd like to hear us answer, go ahead and send it to us anytime. If we get it right after we record a mailbag, I keep it in a folder in our email account and we save it for the next one. So doesn't matter when, doesn't matter how, get us your questions.
I print them out and I mail them to Jeff, his house.
Yeah, Jason's a boomer, so he has to print every email we get and read it that way.
Yeah, I do. I really do. All right, Jeff, we have done it. We have answered the hard questions about investing from our listeners. But guess what? As always, these are our answers. We answered because you asked, not necessarily because we really know. Now, we know our answers, but we don't know your answers. It's up to you to figure that out. But you know what, friend? You can do it. I believe in you. All right, Jeff, we'll see you next time, buddy.
See you next time.